Good morning, good afternoon, or good evening, depending where you are on the planet. And welcome to today's Bull versus Bear webinar. Steve Miley here on the Call for Trade Day. Welcome, everyone. Welcome. We're going to go for our kind of usual Monday. I know it's a Tuesday, but given the US holiday yesterday, given that we had no webinar yesterday because of the US holiday, we're going to go through our kind of Monday run through. We'll take a look at the shape of the week. What are the major macroeconomic, fundamental, geopolitical, central bank issue factors that are coming up this week? Also looking back to last week. And why are we looking ahead for the whole week when we're day trading at trade day? Because depending on where the volatility points potentially are during the week, we might slightly adjust our trading strategy today if we're going to expect maybe less volatility or more volatility, depending on where those potential volatility points come through the week. So I'm going to refer to both the US macro matters. Remember that is published each weekend in the just below. If you're watching this on the live stream or watching it on the recording in the members area, you have those three columns: the left-hand column, technical analysis; the middle column, the fundamental analysis. So that's where you get these reports, the macroeconomic data, the macroeconomic reports, the fundamental reports, the macro matters, which is the longer, more extended version that you're seeing here, and then the weekly recap and update, which you can also download. I usually post these as well in the forums, so take a look at those, please, as we go forward. So let's take a look at, first of all, what we've had and what we've got coming up. US global stocks ended August pretty much on recent highs. They ended August up. So that was another positive in most cases. In some cases, for example, in the European stocks, the European Stock 600 index rose last week to a record high. Germany's DAX and Italy's FTSE MIB climbed to new peaks as well. So positive coming certainly out of Europe. Slight outperformance we've had more recently out of Europe, and then also US stocks. The Dow was sitting at or near record highs last week. S&P 500 not far off the Nasdaq, a little way away still. So you've had like a broader global and a broader amongst the indices and the sectors. It's not all being led on this latest push higher through this recovery that we saw through August, not only led by big tech, which is seen as a positive for sustainability. So we saw that last week. Nvidia did disappoint last week, despite the numbers actually beating expectations. Nvidia ended up disappointing, but nevertheless, still managing to slightly start to rebound. And the whole tech sector didn't necessarily suffer, although tech certainly underperforming in here at the moment, and growth underperforming. The PCE data slightly beats estimates, so lower, cooler than expected on the year-on-year data on Friday. So that's another positive to signal that US inflation continues to slow. And obviously, it's a holiday shortened week this week, with yesterday being US Labor Day. Jobs data very much in the focus. Let's jump down to the major points on the calendar we're looking at. So obviously yesterday was a US Labor Day. We did get the European and Asian and manufacturing PMI data yesterday. Today we get the US and Canadian PMI, obviously with markets closed yesterday, playing catch up today. So those are going to be important. Then we get the European and Asian services and composite data, PMI data, on Wednesday. We also get the Bank of Canada interest rate decision and monetary policy statement on Wednesday. So we're certainly going to be watching out for that, see if any clues as to where they're going on their policy in relation to, obviously, we have the Fed coming up. We'll talk about the Fed in a little bit. And then also we get because we're kind of a day later, because of the US holiday. So you see in here, you had the European manufacturing PMI yesterday. We get the US Canadian manufacturing PMI. Then on Wednesday, we get the European Asian services and composite PMI, and then that's pushed back to Thursday for the US. So the US, we get that PMI. Also get the ADP employment data. That's usually on the Wednesday, but again, because of the holiday, that's pushed back a day. So we're getting the ADP employment data on Thursday, and then the US jobs data and the Canadian employment report as well, both coming through on Friday. So it's a busy week. Because of that US holiday, the PMI data for Europe and Asia coming a day before. So we've basically got back-to-back PMI data from either Europe or Asia or the US and Canada coming through Monday, Tuesday, Wednesday, Thursday, with also the ADP employment and then the jobs report on Friday. So it's a busy week because those PMI data are split out through the week, through Monday through Thursday, because of the US holiday. If we step into yesterday's calendar, you see the PMI data for Europe here. It all comes from S&P Global, but they have different branches. So you've got the HCOB, S&P Global data for Europe and the UK. You can see in here for the Eurozone, in here for France, Germany, and the Eurozone as a whole, all beating expectations yesterday, but with the UK coming in line with expectations. If we jump forward to today, we obviously have it coming up for the US now. Remember, we get both the US S&P Global data in here that comes through at 9:45. But what the more watched data is the ISM data, which we get 15 minutes later. So 9:45 Eastern time, the S&P Global data in here for the US, also for Canada too. And then we get the ISM data for the US coming through at 10 o'clock. For the service for the manufacturing sector. Sorry. So we've got that very much the focus in here going into today. So 9:45, but more importantly at 10 o'clock today, we're watching that. The other thing to mention, which I didn't include actually in the macro matters, neglected to mention, but certainly we'll mention it in next week's, is that this is the last week in here now before the Fed for their blackout period kicks in. So the Fed meeting is 2 weeks away in here. So it starts on the 17th. So starts in here 2 weeks today, and then concludes on the 18th on the Wednesday. So as ever, it's a 2-day meeting, and then we get the result on the Wednesday with very much a rate cut priced in. We'll talk about that as we go forward. But you can see the blackout period starts a week and a half before on the Saturday, 2 Saturdays before the meeting. So we get that kicking in from this Saturday, the 7th. So this week, today, through Friday is the last time for Fed speakers to speak before they go into their blackout period. So that's of note as well. This is the last time we're going to see anything from Fed speakers. And potentially if we get any Fed speakers later in the week after the manufacturing data and after we get the jobs data, that's going to be the critical one. But I don't know if we're going to get any Fed speakers in here. We'll have to take a look as we get closer to. But on Friday, because obviously that's the last, we'll get the jobs data and then there's potential for Fed speakers to speak. But that will be their last opportunity on Friday. Let's jump to 5 things to start your day in here. So US markets kick off September trading in earnest day after being closed for Labor Day yesterday. Tricky, seasonally tricky for stocks, bonds and gold. But nevertheless, coming into it with the potential for a US Fed rate cut in here. A big week ahead. We've already spoken about this and gone through. It rates are pretty high this month. Fed Reserve September meeting. Markets currently pricing in 25 basis points with an outside chance. It says a 1 in 5. On the Fed Watch draw is slightly higher than that for a 50 basis point cut in here. So we got heavy week reports, US manufacturing data in here. I'll just pop this one in here out and we can just see in here. Stocks fall before manufacturing data. So we get the, as we say, the US PMI data, then again the US PMI again later in the week, and then the jobs data on Friday. So a heavy week of reports. US manufacturing on Tuesday, non-farm payrolls on Friday. Another big market theme is trades driven to holidays is the outlook for commodities. Goldman Sachs has slashed its copper forecast for next year, not really impacting us. Cathay Pacific Airways, not really big for us in here. This is kind of outside, should be maybe keeping an eye on this, but so talking about potential in here for the yen in here, and the yen led gains in the group of 10 currencies on Friday. Bank of Japan Governor Ueda indicated the central bank is committed to raising borrowing costs, so potentially in here looking for a stronger yen to come through going forward, potential rate hikes out of Japan. So just to summarize, nothing really going on with all the focus on the manufacturing data in here. The yen is up on the back of that. As we said in here, Ueda reiterates the Bank of Japan may lift rates. US equity futures actually down lower after the holidays. We're actually tracking lower in here this morning, setting up for the busy week. Stocks fall before manufacturing data, same in there, same from your Labour data. Labour report as September kicks off. So again, this is similar to 5 things to start your day. The morning bid out of Reuters. So Labour Day yesterday and the Labour jobs report coming up on Friday. World stock stocks tiptoe, dollar holds as investors await US data again in here. So the market's pretty much on hold, slightly lower in here this morning. Futures drop as markets brace for data heavy week. And so in Asia, we were slightly lower. The Nikkei are pretty much unchanged overnight, but the Hang Seng down 0.25%. European indices lower between 0.25% and 0.5% across the UK FTSE, German DAX, and French CAC. 0.25% to 0.5% lower, and US futures between 0.5% and 0.2% down in here this morning. The S&P down about 0.5%. The Nasdaq down, coming at around 0.2%. I think this is really interesting. I'm going to spend a little bit of time looking at this in here this morning. So FedWatch tool in here, the way this is shaping up, this is kind of structured slightly changing it. So you can see in here on the FedWatch tool is actually pricing in 1 in 3 chance in here of a 50 basis point cut in here. So 475 to 500 would be 50 basis points down from the 525, 550 level. So we're basically putting in a 2/3 to 1/3 chance of a 25 versus 50. But then if we go to November, the market now pricing in, so this over here is for 50 basis points down. So either a 50 and then no change, or 225s in here. And you can see this 47%. So the market is pricing in over 50% chance that by the November meeting, we're at 450 to 475, 450 to 475, which would be down 75. So the market's only really pricing in 25 and then a 50. So it's kind of pricing in that, 25 then 50, which would be kind of non-normal. If anything, often the Fed will go big and then pause, or big and stay big, but they wouldn't normally start gradual and then quickly go big. So the market kind of indicating 25 then 50, and then by year end it's indicating in here, so 30% chance that we're down 75 basis points, only a 1 in 3 chance, 30% chance that we're down total of 325s or whatever combo, 50, 25, 25, 25, 25, whatever it might be. But then, we're pretty much pricing in at least a 70% chance that we've got at least 100 basis points off. 525, 550 is the current target rate, 425 to 450, and then outside chance, nearly a 25% chance we get more than 100 basis points down. So the market's kind of pricing in 25, 50, 25, which is a little bit of an unusual structure. That's very unlikely to happen, 25, 50, 25. I don't know whether there's thoughts around the market maybe pricing in because of the election. So the election is actually, so the meeting is after the election, but obviously there's no guarantee that we get a result at the election, right, on the election day or soon after election day. So the election, I think, is on the 5th, 6th, right? US election 2024, is that right? US election day, maybe that would help. Yeah, the 5th. So it's after. Yeah, so it's going to be interesting. It's going to be interesting because the market kind of very much now pricing in potential 50. So I'm a little confused about how the logic behind how that. If I was trading on the interest rate curve, I will be suggesting that this is what it's pricing in doesn't seem correct to me. I think we go either 50, 25, 25, or the market, or we go 25, 25, or maybe 50, nothing, and then 25. But the market seems to be pricing in 25, 50, 25, which would seem an odd structure to the potential rate cuts. Moving on here, bond yields slightly tracking higher in here. Remember, that's higher yields, lower prices, but we're very much caught in this range in here at the moment. Really, the market, apart from this spike down, has been pretty much between like 377 up to the high around here at 4, just above 4, around 402. So really 375 to 4. We're at the kind of the upper end of that, 392, sort of nudging slightly higher in yield, and obviously lower in price. If you look at remember on the December contracts here now on the bond markets, whether you're looking at the bond, the note, or the 5-year or the 2-year. So, but we're negative on all of these, and if you see the further out we go, the more negative it is. So 30-year bond certainly looks up at topping structure in here and potentially pointing lower. But you go to the 5-year, this looks certainly more negative, and the 2-year even more negative in here, trailing down to lower prices, higher yields, and breaking this trend line. So certainly looks more negative on the outlook in here on the bonds, on price, which is higher yields. But stocks have stayed pretty resilient. We the S&P 500 close to the recent highs on the close on Friday. Nasdaq not quite there, back to the recent highs, and obviously not near the highs of last year. But nevertheless, in the stocks holding in relatively well given the higher yields. Higher yields usually would be more negative for stocks. And if you go to the current markets, you can see in here, on the bonds in here, bonds sort of pointing lower in here, been tracking lower in price. Sorry, that's not the bonds, that's the gold. So bonds in here pointing lower, tracking lower all last week, potential bigger topping pattern in here. You can see the trend line up through here, breaking that trend line. But if we go back to the stock indices in here, S&P 500 sitting right up there on the close on Friday, a multi-week high on the close. Notable setback in here today with the US holiday yesterday, but obviously today's data is going to be key, but we're still very much in that range. For me, I think the risk is we pop back higher in here today, back up into that range, back up to the top of this recent range, going through today's data. But obviously the data is going to be key. Remember that we get that at 9:45 and at 10 o'clock Eastern time. On the Nasdaq in here, again, a setback, probably not quite as negative in here, but nevertheless looking for that potentially bounce back up to the highs that we saw last week, back up to like Friday's closing level, I think. So we are down today, but no strong view, hanging on to a more positive tone in here. But if you look in here, it's kind of a bit of a chop in here. There's the Nasdaq on the 30-minute chart, yes, down on the overnights, but kind of rebounding now. Similar story on the S&P in here. This is the 15-minute chart, down overnight in here, but within that kind of broader range. It was held in last week and then rebounding, sort of bottoming out now. So I think the risk going into today is we just bounce back up, not looking for an extension above the highs. Got a lot of data to come this week, a lot of events to come through, particularly that ADP number, and then obviously the jobs report on Friday. Watching out for any Fed speakers. No Fed speakers that I see at the moment on the calendar for today that I noticed at all, but watching out for Fed speakers as we go through the week as well. Remember, this is the last chance we get. All right, guys, I'm going to wrap it up there. I'm going to wish you all a great trading day. Take care, stay safe, and I'll be back with you tomorrow. Or if not myself, it'll be Duncan. Will be back with you. One of us will be back with you anyway tomorrow for Wednesday's Bull versus Bear webinar.